On March 18th, 2026, the most powerful financial institution in the world met for 2 days, deliberated, and did nothing. The Federal Reserve held interest rates exactly where they were. No cut, no hike, no change. The market fell 600 points. Because doing nothing, right now, is its own kind of decision. And the numbers behind that decision reveal a problem the Fed has not faced in 50 years. The Federal Reserve has 2 jobs. 2. That is it. Job 1, keep inflation at 2%. Job 2, keep as many Americans employed as possible. Congress assigned both in 1978. They called it the dual mandate. For most of the last 4 decades, those 2 goals moved together. Low unemployment, low inflation. The Fed could manage both with one lever, the federal funds rate. Raise it to cool inflation, cut it to stimulate jobs. Simple in theory. But that only works when the economy breaks in one direction at a time. Right now, it is breaking in both. Inflation. The Fed's target is 2%. As of January 2026, the most recent confirmed data, the Personal Consumption Expenditures Index sat at 2.8% headline, 3.1% core, the highest core reading in nearly 2 years. February's official report does not publish until April 9th. Employment. The U.S. economy lost jobs in February. The unemployment rate edged up to 4.4%, the highest since 2023. The labor market is softening. Then, on February 28th, the United States and Israel struck Iran. The Strait of Hormuz, the choke point that moves 20% of the world's oil, effectively closed. Brent crude surged from $70 a barrel to over $109 in 3 weeks, the largest oil supply disruption in recorded history. In a single month, the inflation problem got worse, and the growth problem got worse at the same time. This is the trap, and it has a name economists have been reluctant to use: stagflation. Oxford Economics called the Iran war a stagflationary shock, meaning it can weaken growth and stoke inflation simultaneously. Bloomberg ran the word in its headline. Wells Fargo described the combination of weak jobs and rising prices as the FOMC's worst nightmare. Powell himself refused to use the word at the March 18th press conference. He said he would reserve the term for a much more serious set of circumstances. The Fed has one tool: interest rates. Raise them, inflation slows, but a weakening economy gets weaker and unemployment climbs. Cut them. Jobs stabilize, but inflation reaccelerates on top of an oil shock already pushing prices higher. Hold and you wait while both problems compound. This exact trap has happened before. In 1980, inflation hit 13%. Unemployment was above 7%. Fed Chair Paul Volcker chose inflation. He raised rates to nearly 20%, the highest in U.S. history, and triggered 2 back-to-back recessions. Unemployment climbed above 10%. It worked. Eventually, it took 3 years and cost millions of jobs. The lesson history left: there is no clean exit from a stagflationary shock. There is only which pain you choose and when. Here's where the numbers stand as of March 19th, 2026. The Fed's updated inflation forecast for this year, 2.7%, revised up from 2.4. Inside the dot plot, the anonymous rate projections from each of the 19 Fed officials, 4 to 5 members quietly shifted. From expecting 2 rate cuts this year to 1. The median did not change, the distribution underneath it did. The national debt, $38.9 trillion. Every movement in interest rates costs billions more in debt service, paid by taxpayers. Mortgage rates above 6%. Credit card rates above 20%. Auto loans near 8%. The next scheduled Fed meeting is June 16th. Between now and then, the war continues. Oil stays volatile. The February inflation report has not yet printed. Powell said it plainly on March 18th. We don't know what the effects of this will be. Really, no one does. That is not an opinion. That is the statement of the most powerful central bank in the world. On the record, the numbers are what they are.